Welcome to The Explainer. Today, we're taking the pulse of the private equity market, and let me tell you, it's giving off some seriously confusing vibes right now.
Yeah, I mean, if you look at the latest Q3 report from KPMG, the whole private equity landscape is just full of contradictions. It's a market that looks incredibly strong and, at the very same time, surprisingly weak. How does that even work?
So let's get right into it. This is the big paradox that's got investors scratching their heads.
The question on everyone's mind is pretty simple. Is the market booming or is it busting?
Well, the wild thing is, the answer is kind of both. On one hand, a staggering $1.5 trillion has been invested so far this year. That sounds amazing, right? Super healthy. But, and this is a big but, the actual number of deals getting done has slowed to a crawl. We're talking a decade low. So what in the world is going on here?
Okay, so how is it possible that so much money is flying around when so few deals are actually happening? Well, it all comes down to a few, let's call them blockbuster transactions.
And this is really the key takeaway. This is not a sign that the whole market is healthy. Nope. What's happening is that the total dollar value is getting propped up by a handful of absolutely gigantic deals. These massive public-to-private buyouts, where a PE firm just straight up buys an entire company off the stock market. If you take those out of the equation, the picture looks, well, a lot less impressive.
In fact, get this, just 3 deals make up almost $100 billion of that total. The biggest of the bunch was the massive buyout of the gaming giant Electronic Arts for over $56 billion.
Then you've got the huge deal for Air Lease, which came in at more than $28 billion. You see, these mega deals create a really powerful headline number, but they can totally mask what's really going on, the weakness in the rest of the market.
And Dayforce rounds out that top 3. The thing is, once you look past these giants, the reality is that most investors are being super cautious, holding back because of all the uncertainty out there with geopolitics and trade.
But, even with all that caution in the air, there is one sector that's just a total magnet for investment right now. It's attracting a flood of cash.
It's all about AI. But here's the thing. The AI revolution isn't just about software. It has to be built in the real world. We're talking massive data centers, new and improved energy grids, all the physical stuff you need to actually run artificial intelligence. And private equity firms, they are pouring money into building out that foundation.
And the numbers, they totally back this up. Investment in infrastructure and transport has already blown past $126 billion this year. That's a 3-year high, and we're not even done with the year yet. This, right here, is where the smart money is going. All right, let's shift gears a bit and zoom in on one country that really tells the whole story of this market perfectly. We're talking about India. It's this fascinating place where you have this incredible long-term potential, but it's bumping up against some very real short-term caution. Experts on the ground, like Nitish Padar, are saying this isn't just some passing trend. No, what we're witnessing is a complete transformation of the Indian market, and it's being driven by private equity. Now, sure, 2025 looks like it'll be a little slower than last year, and that's that short-term caution we were just talking about, tied to worries about global trade. But if you zoom out, the bigger picture, the long-term story here, is all about massive, massive growth and opportunity. And what's really cool is how these global PE firms are investing there. They're not just writing a check and walking away. They're acting as business builders. So think of it like this. They'll buy a solid regional company, and then use that as a platform to go out and buy up a bunch of smaller local businesses. They roll them up, combine them, and boom, they've created a huge, much more valuable national player.
Okay, let's zoom back out to the big picture now, because we need to talk about the single biggest problem that's looming over the entire private equity world.
Here's the thing you have to understand. After a PE firm buys a company and spends years improving it, they have to eventually sell it to make their money. It's called an exit. And right now, it's like all the exit doors are jammed shut, creating a massive traffic jam of capital that's just stuck.
And this data lays out the problem perfectly. It's the same paradox we saw before. The total value of the exits looks pretty strong. But the volume, the actual number of companies being sold, is at its lowest point in more than a decade. So you have billions of dollars trapped inside these investments, unable to be cashed out and put to work on new opportunities. So, okay, we've got this really complex picture of megadeals on one side and a huge logjam on the other. What does that mean for the year ahead? What should we be watching for as we head into 2026?
Well, there are actually a few signs of hope on the horizon. For one, falling interest rates could make financing deals cheaper. Plus, the IPO market is starting to wake up again, which could provide that much-needed exit path.
Of course, investment in hot sectors like AI isn't slowing down. But maybe the biggest factor of all is the absolutely massive amount of cash that PE firms are sitting on right now. Insiders call it dry powder, and there's a record amount of it just waiting to be deployed.
And that capital, it has to go somewhere. The big question isn't if it will be spent, but where. And the decisions on where to put all those hundreds of billions of dollars, well, that's not just going to define the future of private equity. It's going to shape the entire next chapter of global business. Thanks for tuning in to this explainer.